just whenever we're. Hello, we're Team University of Idaho, and this is our Itron analysis and investment recommendation. So first, we started our research by looking at the industry. We took a dive into look at the drivers and kind of identified that big component shortage that was impacting everyone. Next, we wanted to kind of narrow down and look just at Itron. So we went into their financials. A few things that caught our eye was their volatile revenues, stagnating backlog, and their capital light balance sheet. After this, we ran a few different valuation models and arrived at our rating. For our rating, we actually recommend a hold price target of $60. So looking at Itron, starting with their strategy, they've got seem to have a go-to market strategy where they just kind of go in and grow off of their current customers and expand that way into different markets, and then find competitors and kind of acquire them. They actually kind of deviated from this recently with their partnership with Cisco. And as a result of that, they actually came out with the open-way Riva system, which was huge because it allowed them to have this big platform to connect all their different products on one platform. So yeah, talking about open-way Riva, it was really awesome because it gives industry users the chance to kind of view all their different products and monitor live what's going on with them. Looking at the geographical markets, we see that 63% of their revenues come from the US and Canada, followed by 30% from EMEA and 7% from Latin America and Asia Pacific. And then if we dive down into Itron itself, we see that their revenue per segment, 40% comes from their electricity segment, followed by 26% from gas, 19% from water, and then 15% from network. Network being the smallest, we do actually see it as having the most promise. And we feel that Itron kind of feels the same way with their recent acquisition of Silver Springs Network. This acquisition was huge. Three of the big things that really caught our eye about this acquisition was over the first 3 years, they will recognize $50 million in revenue synergies from combining and optimizing operations and expenses. This excess cash will help them expand R&D and accelerate innovation and growth. And then they also gained access to 26.7 million more devices in that industrial IoT sector, which was huge for them.
So Itron has been working on these 6 areas shown here, which we believe are essential to helping them drive their growth. And Itron is exposed to fluctuations in the utility, gas, and water industry, and demand from these utility companies is needed in order to continue their growth in AMI and smart metering efforts. And so Itron's outcomes and networking side has a higher growth potential than just the outright metering side. So using CAGR, Itron's global growth projection from 2018 to 2021 for outcomes and analytics is 12%. For networking and communications, 8%, and metering and sensing is 3%. And without the benefit of other high commodity prices like oil and metals, these electrical meter makers are kind of at a disadvantage for pricing power. And we expect the risk of these electrical meters to follow the flow of other commodities. And so we believe that there is a global electrical component shortage. And so with these capacitors and resistors that are small parts that go into these meters, they're in a high demand from Itron and their competitors. And from September 2017 to June 2018, capacitor lead times that were greater than 26 weeks grew from 22% to 56%. And for resistors, they grew from 8% to 35%. Which kind of goes into their risks. So this component shortage issue, we believe, could hinder Itron's ability to generate new sales since it is slowing their manufacturing process. And also with Itron shifting into the smart technology space, we believe that this attracts competitors that have higher service margin revenues, which means that they will need to increase and continue R&D as well as continue investment in their customers.
Okay, so diving into financials, as Lexi and Devin explained earlier, we're seeing this shift in strategy from outright meter manufacturing to services. And we break that into two parts. The first being Internet of Things, integration with smart cities, and the other is software as a service applications for consumers. Over the past 4 years, we've seen the share of service revenues grow to 11.8% for Itron. This has led to a 3.5% increase in their overall gross margin due to the lower cost of revenues for services. However, we do see some volatility in the revenues seen by the revenue backlog represented by the accounts receivables. If we go back to 2011 and 2013, we see the decrease in the accounts receivable correlated with the decrease in revenue growth. And as Lexi was saying, with the global component shortage at the beginning of 2018, we're beginning to see the first signs of new meter orders starting to flatten out, which is causing some analysts to forecast some slower revenue growth in fiscal year 2019. So therefore, strengthening the case to move to services. They're also shifting out of a hard asset balance sheet to improve their ROA. From 2016 to 2018, they decreased the amount of property, plant, and equipment from about 35% to about 26%. Compared to their competitors, this is the lowest percentage of property and plant equipment and has led to about a 6% increase in their overall total return on assets, which is good because you need less factories to pursue your analytical ventures. And then finally, we look at their capital structure. We expect Itron's weighted average cost of capital to remain above 8% with the rising cost of debt and equity. Looking at their solvency risk, we came out with some mixed results. Their debt to equity ratio did almost double in preparation for the acquisition of Silver Springs. However, due to the high cash flow theme of the meter industry, we did not see their interest coverage ratio be negatively impacted. So therefore, we don't see any serious solvency risks for Itron.
Okay, so yeah, we would like to put a hold rating on Itron with a target price of $60 a share, which is an 11% return from its current price at $54 a share. So to get this target price, we look at no PAT as the variable. We use a mean growth rate of 2.5% for 2019 and 2020, and then from 2021 on into perpetuity, we use a growth rate that's dependent on the results of 2019 and 2020. These cash flows gives us a market cap of $2,096 and an enterprise value of $1,929. We then look at the sensitivity analysis with an average WACC growth rate of 9% and an average no PAT growth rate of 2.5%. And then after that, we look at a comps analysis. We focus on the valuation multiples. And as you can see, Itron is undervalued to its competitors in the revenues, EBITDA and EBIT multiple versus its price to earnings multiple is overvalued to its competitors. We then run a Monte Carlo simulation with 1,000 occurrences, and we get a mean price of $50.06 and a standard deviation of plus and minus $6.63. You can see that the majority of the hits happen in the $46 to $54 range at 291 occurrences. We do believe, though, that the fundamentals are there to boost up the price $10 to our target price of $60 a share. And after that, we can formulate a blue sky, gray sky analysis. We get a blue sky price of $75 a share, and that can be attained from continued industry growth and innovation, a return to cash, decreasing the change in net working capital, and successful growth in our M&A transactions previously. And on the flip side, we have the gray sky price of $35 or a negative 35% return. And that can be caused from slowing industry growth due to market saturation or excess competition, continued plant, property, and equipment expenses, bleeding out future cash flows, and customer backlog defaulting, decreasing your no PAT number. All in all, there's a 4% skew to the upside. All right, and to sum it up, we would like to put a hold rating on Itron with a target price of $60 a share. Any questions?
10 seconds to spare. Nice.
That's how we do it.
You guys flip back to you had a slide that showed PP&E decreasing. I was curious why you're going back to it. Is that 100% a function of them doing acquisitions, so their intangibles are going so much higher, or are they actually literally shedding intangibles?
Yeah, so we factored in, part of it was for the Silver Springs acquisition. We have a feeling that they had to reach past their cash that they had on hand to leverage up, and that was kind of eating away at that networking capital number there.
And given that they've done, some 2 large acquisitions over the last 18 months, do you think there's a risk that they may have to take a charge for that in terms of, or is there a history of them doing acquisitions where they have to take charges?
In our past analysis, we did see some pretty serious restructuring charges following some of their acquisitions.
A couple of days ago, the company came out with 2018 results and 2019 guidance. I know that was after you turned in your slides for this, but I was just curious, kind of how, particularly 2019 guidance, does that change your view on the company, and how does that play into your analysis of thoughts going forward?
So primarily, like, we definitely looked at that and kind of saw it and were surprised at some of the results, but we definitely still do stick by our analysis with how the market's been pricing it these past couple of days. We definitely, because we did see that big decline in share price. We were getting a little scared there at the beginning of the year. We saw
My target price.
yeah, we saw there was a little bit of a bull run there at the beginning, but we saw that decrease here in the past week or two. Kind of reassured us that we're pretty solid on our recommendation.
I don't know if are you using GAAP or non-GAAP results to value the company?
I use GAAP.
Did you guys do a non-GAAP EPS calculation as
Did
well?
not.
Okay, I was going to ask how it aligned with the company's.
Yeah, we pulled all the numbers from CapIQ. So.
Okay.
It was good detail you gave on the component shortages. I'm looking at the capacitor lead times. How'd you get that data, or how'd you calculate it? Where did that come from?
We pulled that data from a website that just took a survey from different electronic suppliers and the relative lead times that they've been having over the past 2 years. So they expect this shortage to continue through 2019, and then the supply should catch up by 2020.
And I believe, for clarification, I believe our source for that was FactSet.
You know what's causing that?
I think just overall demand for new electrical components. We're in a tech boom era. I think if there's electronic vehicles who use it for their catalytic converters, TVs use them, phones.
Pretty much any technology works with these guys.
Yeah.
So the company's realigned business segments, which I think you guys talked about. Looking at the historical financial results and the details that the company put out a couple weeks ago around this new business segmentation, does that kind of change how you're looking at the company or thinking about potential opportunities, areas of growth?
We think Itron taking the right steps, shifting the service segment. I think, with the compound annual growth rates that you guys are predicting, I think in the strategic acquisitions over the past 5 years, I think Itron is positioning themselves pretty well for the future. However, as kind of in the 2019 guidance, we're still seeing that restructuring costs from these acquisitions coming through, and we kind of foresee that for the next 2 to 3 years to kind of be a headwind.
And I think that move there kind of moved more towards the networking, seeing that it is kind of like their newest new segment. I think that's a very positive move, especially with the smart city ideas and all the different things there that they're working on. And I think that that kind of played a part into our valuation too, just because like, as you were saying, like the headwinds, the initial getting over the different bumps and stuff of setting that new segment up, I guess.
I think we saw a lot of investment in the business, which was why, from the valuation perspective, why we wanted to boost the target price above the simulations that we ran.
The company's most recent earnings call, they mentioned that PG&E going bankrupt could potentially be a positive. And then obviously when one of your larger customers goes bankrupt, you obviously have accounts receivable risk and different issues. How do you guys kind of frame that? And is it a risk? Is it a catalyst? When you look at that, what do you think?
I think just to the one slide with the correlations of the accounts receivable and the revenue growth, I think I asked this question during the investor relations meeting. It's good that, Itron continues to book business going out into the future, but if you have some anomalies like PG&E, that, maybe the ratio of accounts receivable to actual revenues realized, those things get out of balance, that could be a risk.
You showed that they get a good chunk of their revenues from Europe. How are they? How do currencies impact them? How does the movement in the euro dollar exchange rate? How does that affect them?
Definitely do see it impacting them just with obviously conversion and stuff. But I believe at the investor thing we went to, they discussed that there is some sort of hedge they do there, but
Yeah, the speaker said that there's little issues or risks to the forex markets.
Do they hedge currency?
Yes.
So they recently announced a CEO transition. Their CEO will be retiring at the end of, or at least by the end of 2019. Do you see that as a risk, an opportunity? How does that factor in?
I think that initially, like when we first saw the news, we kind of expected it to be kind of bearish, but the markets seemed to like it. And I think that kind of signals that maybe they were ready for a bit of transition in their corporate governance. Someone getting some new, fresh ideas in there, hopefully will be positive for them.
What do you guys see as their largest geographic opportunities going forward in terms of North America versus Southeast Asia? And how should we think about kind of the growth potential in the industry over the next 10 years?
I definitely would say their more growth potentials would definitely be over Asia Pacific and Europe, mostly Asia Pacific and kind of just emerging markets and places where they might not be in there yet because there isn't the infrastructure to sustain them yet. I feel like that's their biggest opportunity to get into those kind of transitioning countries that are kind of coming up to speed with all of us kind of already on the grid.
And I think even a bigger macro perspective, with country abroad, we're starting to see expansionary monetary policies in these emerging markets, including China and possibly Europe here pretty soon. So might be able to ease business liquidity going forward.
Did you look at all at how they stack up on a competitive standpoint relative to their peers in the market as far as their technology?
I know that so one thing that we did notice is more recently, so they obviously are pretty advanced with their tech, but they've kind of been a little more like second to market where they kind of just come in and offer someone else's tech and kind of expand. And obviously they have a bigger customer base. But I think they're pretty even. Obviously that open way REBA system really kind of gives them an advantage with their smart cities and all that type of stuff.
So they recently took on a significant amount of debt related to the Solar Spring acquisition. how do you see their plans for delevering over the next couple of years? Is that a risk or are they well positioned?
Yeah, so through the valuation, we kind of believe that going forward, they would kind of return back to cash. And so they'd be eating away at the debts that they made. And
That's time. Thank you, guys.
Good job.